Job order costing. We're looking at Chapter 2, Part 2, and now we're going to go through the journal entries as we walk through the manufacturing process that we've discussed in Part 1. So here's what the record would look for job costing. Here would be an example for a job. This is job B15. If you look, they have issued direct materials, they've issued direct labor, and they've issued overhead. And then you add all these up, and that tells you the total cost. This would be a job cost sheet. So you kind of get an idea what that looks like. Although I think this is all done on the computer, I don't even think you see a sheet. So let's now look at our journal entries. So the thing to remember, although you may have 3 jobs with different amounts, when you go to book it and take it out of raw materials, it's going to go to raw materials inventory, one account, and the total would be work in process inventory. You would not do these individually, although you would have a subsidiary ledger that would keep track of all this stuff by job. Now here's what happens when we do the labor. And in this case, we've got some that goes to direct labor, which would be go directly to work in process, and that would be work in process. And then we have how much goes of labor would go to, in this case, you would take your direct labor times our predetermined overhead rate, and this would be what we'd call applying overhead. Here is taking materials and putting it into overhead. And here's labor putting it into overhead. And here are other costs putting it into overhead. Now again, our cost flow is direct labor, direct materials, and manufacturing overhead goes to work in process, which then, when an item is complete, goes to finished goods, then goes to cost of goods sold. So now let's actually walk through a problem, and it will go line by line so you can see this whole process. So here we have a company, they make campers, they are doing job costing. So the first thing they did was they purchased $470,000 in materials on account, which means it would be accounts payable. Then they used direct labor, and it shows by camper how much they spent, with $36,000 going to one, $28,000 to the second camper, and $19,300 to the third. But when we book it, we have to add all, remember this when you're doing your homework, you have to add all these together to book the journal entry. So it goes work in process, and the offset portion $31,000. The difference here for the wages would go to overhead. And then the offset would be wages payable. Now let's look at the T accounts so you can see what this looks like. So here's what we did. We bought our raw materials, and then we booked our labor to each one of the 3 campers. If you notice in work in process, I'm keeping them all separate because if I complete one, I need to know how much cost I'm going to transfer to finished goods. So again, that's why I have to keep all these separate. Now let's go on to direct materials were issued for each of the campers. Again, although each one we keep separately, when we do the journal, we add them all together for work in process, with the offset being raw materials inventory. And there you see the line item again. If you notice, it's by line. Now we've had some more costs associated with overhead, and we're going to book this. And in addition, we're going to allocate the overhead to work in process. Remember, when we allocate it, goes to work in process, and it's going to be 60% of direct labor. So we're going to debit work in process and credit manufacturing overhead. Now we've completed campers 1 and 3, which means we're going to take it out of work in process. But of course, we need to know how much cost we're going to transfer, and we're going to put it into finished goods. So what we're going to do is add them up so we know how much. And so together, items 1 and 3 equal $258,680, and that is what's going to go to finished goods. But if you notice, we still keep them separately. Now we have an ending balance of camper 2 in work in process. Now camper 1 was actually sold, so it's going to be accounts receivable, sales revenue, and cost of goods sold, finished goods. So we're doing, obviously we're doing perpetual inventory system. So let's look at our T accounts. So what we have done is we are going to take camper 1 out of finished goods, and we're going to put it to cost of goods sold. Now we're going to do our balances. Raw materials, we have a balance of $243,100. That would go on the balance sheet. Finished goods has an ending balance of $93,580. That also would go on the balance sheet. And the ending work in process of $101,500 would go on the balance sheet. And the $165,100 would go on the income statement. But wait, we have to now check to see, have we applied under or over applied our overhead? And in this case, we have a balance of $4,200. And that means we are under applied, and we're going to have to increase cost of goods sold. Here's our journal entry. And if you notice now, we have zeroed out cost of goods sold, and now, overhead, and now cost of goods sold is increased to $169,320, and that's the cost of goods sold is what's going to appear on our income statement, and the $438,280 is what's going to show on our balance sheet. And that concludes our journal entries.